Welcome to today's video, where we'll dive deep into the world of gross domestic product, or GDP, and how it plays a key role in the forex market. If you're a forex trader, you will know that understanding economic indicators is crucial. The GDP is one of the most important tools in economic analysis and decision making for traders. In this video, we'll break down what the GDP is, how it is calculated, and how it influences currency pairs in forex trading. Let's get started. Let's first answer the question of what GDP is. The GDP is a measure of a country's economic health. Specifically, it calculates the total value of all final goods and services produced within a country during a specific period, typically annually or quarterly. It doesn't matter if these goods are consumed locally or exported abroad. The GDP is essentially a snapshot of a country's economic output and is one of the most widely used indicators of economic strength. Now, you may be wondering, how is it calculated? Well, it is based on four major components: consumption, investment, government spending, and net exports. These components represent the various channels through which goods and services are bought and sold. Each component plays a vital role in the economic activity of a country. For example, consumption represents the spending of household-owned goods like food, cars, and clothing. Investment involves businesses purchasing assets like equipment and buildings, while government spending includes things like public salaries, military expenses, and infrastructure. Lastly, net exports measure the value of goods produced domestically but sold abroad. When calculating GDP, we use the following formula: GDP equals consumption, investment, government spending, and net exports. Let's break it down. Put them all together, and you get the total value of all the goods and services produced in a country, which is the GDP. There's also two different types of GDP: nominal and real. Nominal GDP reflects the current price level, while real GDP adjusts for inflation, offering a clearer picture of an economy's true growth over time. Next, let's talk about the GDP growth rate, which is another critical factor in the forex market. If a country's GDP is growing faster than that of its trading partners, its currency tends to strengthen. This is because investors are drawn to countries with stronger economies. On the flip side, when GDP growth slows or contracts, the national currency often weakens as investors look for better opportunities elsewhere. However, keep in mind that GDP isn't the only factor that impacts currency values. Political stability, inflation, interest rates, and external events also play a significant role in determining exchange rates. So while GDP is a key indicator, it is essential to consider the bigger picture. Now, you may still be wondering, why does GDP matter in forex? Traders should keep a close eye on the GDP because it serves as an indicator of a country's economic strength. So when GDP is high, it signals that the country is producing more goods and services, which typically means higher incomes and greater consumer spending. This strengthens the national currency, making it more attractive to foreign investors. A growing economy is a good sign that the currency will appreciate in the long term. However, when GDP shrinks or slows down, it signals economic trouble. A country with a weak or declining GDP will attract fewer investments, and the demand for its currency may decrease, leading to a weaker exchange rate. Also, GDP is a valuable tool in fundamental analysis. By comparing the GDP figures of different countries, traders can make informed predictions about currency movements. Historical GDP trends provide insights into a country's past economic performance, while the growth rate helps forecast future economic conditions. Comparing GDP between two countries allows traders to gauge which currency is likely to appreciate or depreciate over time. Now, when it comes to the US dollar, GDP plays a significant role. If the GDP of the US is growing, it usually signals a healthy economy with more jobs and higher consumer spending. This drives demand for the dollar, strengthening it against other currencies. On the other hand, a slowdown in the GDP can indicate economic contraction, making the dollar less attractive for investors. Furthermore, the GDP also influences gold, which is often seen as a safe haven asset. When the economy is growing and the GDP is rising, investors tend to shy away from gold, preferring to invest in riskier assets like stocks. This results in a drop in gold prices. However, when GDP slows and the economy enters a recession, demand for gold tends to increase as investors seek a stable, secure investment, which pushes gold prices higher. To sum up, GDP is a vital economic indicator that measures a country's overall economic activity. It plays a critical role in the forex market, influencing currency strengths and investor decisions. Whether the GDP is rising or falling, it tells traders a lot about a country's economic health and its future prospects. An increase in GDP can lead to a stronger currency, while a decrease can lead to a weaker currency. So, have you taken GDP into account when selecting currency pairs to trade? And how do you incorporate GDP into your forex strategy? Feel free to share your insights and thoughts with us in the comment section below. Thank you for watching, and we hope to see you again next time.